Welcome to this explainer. Let's be honest, today we're taking a look at something that might traditionally seem a little, well, dry. But we are going to transform it into a highly logical, really easy to digest playbook. We are talking about IAS 27. Now, if you're an accounting professional, understanding the mechanics of separate financial statements is absolutely crucial. Because getting these rules wrong doesn't just give you a messy balance sheet, it creates massive, totally avoidable audit headaches down the line. So we're going to break this all down, pull out the essential takeaways, and give you a rock-solid guide to mastering these rules.
All right, here is a quick roadmap of our journey today. We've got 5 stops: the evolution of the standard, the core objective and definitions, the actual preparation mechanics, a really specific exception for investment entities, and finally the disclosure requirements.
So let's jump right into Section 1, the evolution of IAS 27. Before we trace the timeline, we need to establish our foundation. We are pulling our rules directly from paragraphs 1 through 20 of the official IFRS Foundation document. Literally every single paragraph here holds equal authority, and it has to be read in the context of the broader conceptual framework. So you can be 100% confident that what we're covering today is the definitive, authoritative source, no guesswork here.
Now, over the years, IAS 27 has actually seen some pretty major refinements. Back in 2001, it started out as a much broader standard that covered both consolidated statements and investments in subsidiaries. Then in 2003, it was revised to cover consolidated and separate statements under one single roof. But the real game changer hit in 2011. That's when the board split the guidance. They moved the consolidation rules completely over to IFRS 10, dedicating IAS 27 entirely to just separate financial statements. Later on, amendments in 2012 brought in special rules for investment entities, and in 2014, it was updated yet again to allow the equity method. So it's really been a journey from a broad, catch-all standard down to the highly focused guide we use today.
Moving right along to Section 2, Objective, Scope, and Definitions.
You know, it's actually incredibly helpful to visualize the difference between these reporting types. Think of consolidated financial statements as the big, whole family photo. Sure, it's sometimes chaotic, but it shows everyone together as one single economic entity. Separate financial statements, on the other hand, that's the individual portrait. It's just the parent company standing totally alone, accounting for its investments in subsidiaries, joint ventures, and associates using very specific, standalone methods.
Here's the kicker, though. IAS 27 does not actually mandate which entities must produce separate financial statements. That's right. Instead, it applies specifically when an entity either voluntarily elects to do so or is required by their local regulations to present these standalone portraits. But if you are going to present them and you want to comply with IFRS, this standard dictates exactly how you must handle those investments.
All right, Section 3, Preparing Separate Financial Statements. Let's get into the actual mechanics.
When a company actually sits down to prepare these separate statements, the standard gives us a very strict rule of 3 for our accounting methods. You have to account for your investments in one of 3 ways: at cost, in accordance with IFRS 9, which generally means fair value, or using the equity method as described under IAS 28. Now, here's the golden rule to keep you out of trouble. Whatever method you choose, you absolutely must apply it consistently for each category of investments. You cannot mix and match cost and fair value for different subsidiaries within the exact same category. Structure and consistency are literally everything here.
So, how do we handle the income from these investments? Well, dividends are recognized in the separate statements when your entity's right to receive that dividend is firmly established. But you have to be super careful here because your accounting treatment completely flips depending on which of the rule of 3 methods you picked. If you went with cost or IFRS 9, that dividend goes straight into profit or loss. Boom, simple. But if you elected the equity method, that dividend is treated as a return on your investment, so it actually reduces the investment's carrying amount on your balance sheet instead of hitting profit or loss. It's a fundamental distinction, and you really do not want to get it wrong.
The standard also anticipates corporate restructurings, which is pretty neat. Say a parent reorganizes the structure of its group by establishing a brand new entity to be the new parent, what happens then? Well, if the new parent gets control by issuing equity instruments and the assets and liabilities of the group remain identical and the original owners keep the exact same absolute and relative interests, basically, if the economic reality hasn't changed one bit, then the new parent measures the cost of its investment based on its share of the equity items from the original parent statements on the reorganization date. It's just a really elegant way to ensure continuity in your numbers when the underlying business hasn't actually changed hands.
Which brings us to Section 4, the Investment Entity Exception.
Okay, things get really interesting here for investment entities.
Think of your private equity firms or venture capital funds. These entities manage their investments on a fair value basis. Because of that highly unique business model, IFRS 10 actually requires them to measure investments in subsidiaries at fair value through profit or loss, rather than consolidating them. And IAS 27 mirrors this logic perfectly. It explicitly states that if a parent is required to measure its subsidiary at fair value through profit or loss for consolidated reporting, it has to do the exact same thing in its separate statements. So that rule of three choice we just talked about, it goes right out the window here. Fair value is mandated.
But of course, businesses evolve, right? If an entity's status changes, you follow a very logical if this, then that protocol. Step 1. If you become an investment entity, you immediately switch to measuring your subsidiary at fair value through profit or loss. Any difference between your old carrying amount and the new fair value on the date of that status change is recognized as a gain or loss. Now, step 2. If you cease to be an investment entity, you revert right back to the standard rule of 3. The exact date you lose that status becomes your deemed acquisition date, and the fair value on that day becomes your brand new starting cost. It keeps the books perfectly aligned with the operational reality of the company.
Finally, we've reached Section 5, Disclosure Requirements.
Because let's face it, preparing the numbers is really only half the battle. Transparency is the ultimate goal. When you prepare these separate financial statements, you have to provide a very specific roadmap for the reader, and crucially, for your auditors. First, you must explicitly disclose the fact that these are separate financial statements. You have to identify the consolidated statements they relate to. Then, you need to provide a comprehensive list of all significant investments in subsidiaries, joint ventures, and associates. And that list has to include their names, their principal places of business, your proportion of ownership, and a crystal clear description of which of the rule of 3 accounting methods you actually used.
And remember, if you happen to fall under that investment entity exception we just discussed, your disclosure burden shifts a bit. If an investment entity prepares separate statements as its only financial statements, it has to explicitly disclose that fact. But here's the big catch. It must add in all the specific, detailed disclosures relating to investment entities that are required by another standard entirely, IFRS 12. Listen, this is a massive compliance trap. You can't just rely on IAS 27 alone if you're an investment entity. You have to bridge over to IFRS 12 to ensure you are fully compliant. So having walked through the evolutionary history, that critical rule of 3, and those strict disclosure checklists, the only thing left to ask is, are your separate financial statements truly compliant with IAS 27? The rules are incredibly logical once you break them down, but as you've seen, the margin for error is razor thin. Next time you sign off on a standalone corporate portrait, just make sure you aren't accidentally painting outside the lines. Thanks so much for joining me on this explainer. I'll see you next time.